All right, so good
You wanna-
evening, everyone. Thank you for joining us today. My name is Mariana, and I'd like to welcome you to today's webinar. Before we get started, I want to let you know that the ERC crowdfunding offering ends in just a few days. So we're going to dedicate a bit more time today to ERC in both basic and advanced informational session. But at the end, we can have a Q&A for both ERC and Gulf Suites as well. If you don't get your questions answered, please feel free to email us at investors@gulfsuites.com and someone will get back to you as soon as possible. All right, Jerry, are you ready? Let's jump in. I'd like to welcome you to our speaker and chairman today from Gulf Suites, Jerry. Good evening, Jerry. How are you doing today?
Good, thank you, Mary. Thanks for producing and hosting us here. I think that why don't we should spin wheels here for a couple of minutes. I think I see the number count, going up. Let's just give it a minute or two. What do you think, Ryan? Is that okay?
Yeah, we can give it another minute or two.
Yeah, okay, that's fine.
Sounds good, yeah.
I got introduced as chairman of Gulf Suites. I think there's probably a lot of folks on here who are existing shareholders, know that I'm chairman of both companies. We talk about these companies interchangeably more and more because so many people are shareholders. I don't know what the ratio is. Something tells me that about half, 2/3 of our shareholders probably are at both companies. We like that. We like that asset allocation. So, but we are going to lean much deeper into ERC Communities tonight because its last Reg A offering that has dividends and preferred stock ends this coming Monday. So for those of you who like preferred stock and for those of you who like dividends, you want to get into this now because we're not bringing it back in our new offerings. So, so you think it's good? Think it's okay to start now, Mary? Ryan, is that good to go?
That sounds good.
Let's get going.
Okay, well, Jerry Ellenberg here, chairman of ERC Communities. As many of you know, I'm also chairman of Gulf Suites. Tonight, we're going to lean heavily into the ERC discussion because our second Reg A campaign that we started last year about this time is ending this coming Monday at midnight California time. And once that ends, there will be no chance anymore to buy Reg A shares with preferred stock classification and with dividends. We're going to be offering common shares after that. And so for those of you who are dividend minded, you want to get into this, stock now. That's not a sale pitch. That's just an advisory. There might be people on this call who like the common stock better, but the preferred first money out stock with dividend offerings will stop being offered. Now, those of you who have shares, that bought shares in the first and second campaign, obviously we keep paying those dividends. So don't get confused. We announced this a while back, and about half a dozen people panic, like, oh my God, you can stop our dividends. We're not stopping any dividends. The dividends will continue. We're just not going to offer new shares that offer dividends. So I hope that's clear. Go ahead, Mary. Let's take us to the next slide. So what are we? I fear that some of you on this call, this is going to be repeat. So I'm going to blow through this pretty fast. We are a real estate developer, builder, and owner-operator of build-for-rent, single-family manufactured home communities. We buy land, we build on the land, we do all the infrastructure, underground roads, landscaping, pads, so forth, and then we buy and bring in brand new double-wide 1,400 square foot homes, 3-bedroom, 2-bath, very similar to conventional homes, and we place those homes on the lot. We affix them to the ground and do all of the hookup work, and then rent those homes out. We are competing with standard built, what is called stick built homes at much lower rent. And we're also now competing with multifamily apartment rent, as many young adults, particularly they get into family mode, want to have free space, separate living, little backyard, walk, 10 steps to their car instead of 75 yards. And it's a natural step. It's a natural stepping stone from apartment rental into home ownership. Our strategy centers around sourcing and development of land. My partner, Ryan Kenning, and I have been doing this in all our lives. the last 10 years together. And then, of course, purchasing these homes and getting them installed. That is the long and short of what we do here. And again, for many of you, I'm sure this is repeat. You've seen our offering circulars, you've seen our pitch decks. It is a new strategy in that the overwhelming majority of manufactured housing is a discipline in which people like us buy land, develop the land, bring homes in, and then sell those homes to homeowners. And those homeowners then pay us rent. We're not selling the homes, we're keeping them all together and renting them out. So it's a more affordable factor for the families moving in. Go ahead, Mary. So what is the opportunity? It's threefold. It's affordable housing. Anybody following the news these days, even a scant attention being paid to the news reports we see today, know that just affordability of anything right now is a mess, and it's really hitting housing hard. Down here in Florida, where we are, we're just getting crushed because we have so much migration, so much population rolling in. And of course, as that happens, that's called demand. Demand, of course, pushes up prices, and things become just terribly unaffordable. When we first conceived of this back at COVID time, we thought we'd collect $1,500 a month rent. We're now scheduling damn close to $2,000 a month, and we're not going to be renting homes till the end of the year. We don't even know what they're going to be then. We have all kinds of inquests coming around from various county agencies and so forth to give them a call once we have the homes available because of the demand. We pay this offering, which ends this Monday. Again, this ends on July 3rd, but as of today, as of this webinar, you earn a 10% annual yield dividend. Invest $5,000, you get $500 a year, and it's paid to you $125 a quarter. That now goes back 3 or 4 years that we've been doing this. And this is Regulation A preferred stock. I always tell everybody, go on Google, look up preferred stock. Preferred, the word prefer means preference. It means more important. It means first in line. Kind of like first class on an airplane, okay? And so we sell these assets, we sell the company. The first thing that gets paid is your investment. Nobody gets anything until all of your cash investment is paid back, and then we share after that. To the degree it's a successful monetization, IPO, sale of the company, anything like that, then you can convert your preferred stock to common and get that higher amount. So you basically get your share of ownership in the company, but never less than the amount you invested. That's what preferred stock means. Google preferred stock, Google convertible preferred stock. So you really understand what that is. And then reach out to me, reach out to Ryan, reach out to any of our people, with any questions on this. All right, Mary. What's the opportunity here? This is really an economic question. You have financial considerations, you have economic considerations. Finance has to do with money, economics has to do with human behavior. And in economics, the two key real tenets of basic economics, economics 1 at your community college, are going to be two principal factors: supply and demand plotted against risk and reward. And in anything you invest in, our two companies or any 100 others, if I were your professor, I would guide you to make sure you're investing in stable, increasing demand, and at the same time, stable or decreasing supply. Trite example, article comes out about Phoenix here a few weeks ago, going to be a shortage of water. They're going to turn off water permits for Phoenix. What do you on this call think that does to the prices of homes in Phoenix? It shoots the prices of homes up because the market economy knows that if you constrain supply, Phoenix is a great place to live. So the demand goes up when supply goes down. So you want to be in tight supply situations where there's a lot of demand. Well, here in Florida and throughout the South, that just defines affordable housing, entry-level housing. We're not dealing with $1 million beachfront properties and luxury golf course communities. We're dealing with families, probably on average early 30s, mid 30s, on a stepping stone, 3 or 4 years waiting to buy their home. Item number 2 there, risk reward being the other factor. You want to kind of discern who you are. what kind of risks am I willing to take? Higher risk you take, the more chance you have towards reward. This asset here, this is not cryptocurrency. This isn't oil drilling. This isn't get rich overnight. This is very stable, fundamental economic investing. And you're going to have a very nice, predictable gain over time, very nice equity build. By and large, this is an investment you're not going to lose sleep over, like you might on crypto, Bitcoin, stuff like that. This leans very, very far to the conservative side of investing. So it's very low risk with very good, stable return. No one's going to come into ERC and think they're going to triple their money in 6 months. That's just not going to happen. You may triple your money, but it could take, a decade to do it. Okay, Mary, go ahead. Some of this stuff I've really already touched on. We do believe it's a unique strategy because we sense that someone's doing number one here. We sense that someone around the country may be buying brand new homes and renting them out. We just don't know who is. If they're doing it, they're being pretty quiet about it. We're doing a very specified, very vertical, very narrow approach here. Only brand new homes. We're not going in and buying existing manufactured home communities, and then buying used homes and going around and, making deals with people who own them to buy them, then move out, rent homes to someone else. No, we're building brand spanking new, all underground utilities, all public, no septic tanks, no water wells. It's all public utilities, all in incorporated areas, good county areas, and 100% brand new homes. When we surveyed this back at the beginning, again, during the tail end of COVID, we asked a focus group question. How would you like living in a new home? And just as importantly, look out your window and all you see is new homes. And there was a tremendous response to that. No one had really thought about that. If you go into existing communities these days, anywhere in the nation, they're typically 20, 25, 30 years old. You have a variety of different homes in there, some that were there at the beginning, some that just moved in this week. So you have this wide mishmash of new versus old, well-kept versus not well-kept. We're going to run these parks like marine bases. I happen to be a mobile home park landlord, have been for decades. I'm quite a snob landlord. I'm kind of a fussy guy when it comes to this stuff. And we're going to be, you're going to be able to lick the driveways in these communities. I'm being a little sarcastic there, but they're going to be kept very nice, very tight management. Size, minimum 60 units. I don't really even like 60 units. We've got 60 unit sites now, but they're contiguous. So our first actual core development is going to be 185 units, a 60, a 60, and a 65, all next door to each other. So it really is a 185 unit development built in three phases as we get zoning and so forth on land that we own and are in contract on. People ask, what are you going to do with these communities, Jerry? We're going to keep them. And this is a portfolio build opportunity. This is not a build and flip. In a later slide, you'll get a feel of what we're sensing in terms of value growth at completion of construction. Roughly 1/3, 30-35% asset growth, 10 million spent on an asset should come home at about 15 months from ground break at a $13.5 million value. I'll explain that later. So you may ask, why don't we just sell it? We don't want to do that because I personally think that 13.5 could be worth 17 to 20 million 3 or 4 years down the road. Tremendous tax advantages, tax-free cash flow. All these dividends are tax-free, and tremendous growth potential as we take the equity that we build. We potentially refinance that if interest rates are fortunate or in good range for us. Mix that capital with new shares that we sell, and we just have kind of an exponential growth. I have to be very careful about this. Is my opinion. This isn't a projection, but I think we get this thing up to 4,000 or 5,000 rental units over, say, 5-6 years. We're going to be a major force and can be very ripe for a merger, initial public offering, something like that. So this is portfolio build. That's the term. You're coming in this company in a portfolio build discipline. Okay, Mary. Target markets, I think you all pretty well know this. You're looking at the southeastern sector of the country. We're not limited to that. Hell, we could build these things in Boise, Idaho. We could build them in Butte, Montana. We could build them, we could build them in various suburbs of New Jersey if we wanted to. But in looking at that map there, that is really where that's the affordable sector of the country. And ironically, Florida is starting to lose that characteristic. It's getting pretty expensive down here. We think that we'll buy land down here over the next 2 or 3 years, and we may get run out of Florida for land price. You'll see us in Alabama. You'll see us up in areas of Georgia, Mississippi, all throughout the South. We are basically going to be a southeastern United States concentration. Of course, looking at opportunities as they arise. Something comes up in Kansas, something comes up in Nebraska, something comes up in Iowa. I've owned real estate in all those states, and we'll be very open to that. But we get asked, where's your focus? This isn't an exclusivity. It's just a focus. It's going to be southeastern United States. Affordability, easy, right to work states, and good youth. And the type of markets that we are after. This is not a good California product. It's not a good New York product in the urban areas like Los Angeles and so forth. Way too expensive, can't afford the land, and we would never get this zoned. So this is where you'll see us going. Go ahead, Mary. Rental housing, rental living, albeit counter to what has been known in my generation as the American dream, meaning home ownership, seems to be waning. Young couples have all kinds of options now of what to do with money, and you have a tremendous percentage of people now opting not to own. You have those who cannot afford to own. You also have those who can afford to own but opt not to. So rental, our American culture, frankly, is moving away from self-owned real estate to other-owned real estate, where people are opting to live in real estate that they don't own. That's quite a cultural shift. I'm not an economist. I'm not a sociologist. I don't know what really all of the intricate factors that drive this, but it is being driven. We are renting at, in our opinion, 25 to 35% under what you're going to have to pay in a new modern garden apartment. We're coming out, we're projected right now at 1895, the first 60 units at Zephyr Hills, 1,400 square foot, three bedroom, 2 baths, self-parking, spot right in front of your house. And within 15 miles, we are seeing 1 bedroom, 1 bath, under 1,000 square feet at $2,100 a month. So it's just a population bomb going on down here, and we think that we will safely stay under the overall market pricing for conventional homes and multifamily. Look at that bottom target there, where you see that 32% of millennials own homes, as opposed to 60% of Gen Xers, which I think are my kids' age. Of course, 75% of my age, baby boomers. I was raised in, you get a job and you own a home. That's and you had kids. That's what you did. And so, I'm still part of that culture, and I presume I'll own my home till I die. But that is an amazing shift. 72 generations, 75% down to 32. It's almost a 2/3 drop. And that is a cultural, socioeconomic move there, not just financial. In my golf company, for example, in Golf Suites, again, some of you shareholders in that company, we're going into some downtown locations now for indoor simulator lounges, and we're seeing 35, 40-year-old couples buying $700,000, $800,000 condos, renting $10,000 a month apartments. They're just moving away from traditional home ownership. So we're capitalizing on that as best we can. Go ahead, Mary. The leadership team, Jerry and Ryan here. You have Ryan Ellenberg on this call, who runs our capital markets, runs all of our share sale activities and so forth. There's another Ryan here, Ryan Kenny. Ryan and I been in business together since 2010, the home building business. We are the two co-founders of both these companies. We're the original founders of Golf Suites, and we are the obviously the founders of this. My background is that of public accounting. I hold an inactive California CPA license because I just don't practice anymore. I've been in real estate for darn near almost half a century, built up a 26,000 rental unit mobile home park chain over the years, sold off the most of it, went into home building business with Ryan. Ryan is a builder, a consummate builder, has 2/3 of $1 billion in construction completions on his resume before he hit 35 years old with major companies. I always try to rattle some of them off: Turner Construction, Zarimba Construction, CalPERS, the famous California Public Employee Retirement System, Wood Partners, Camden, the Camden REITs. He's just done some very prestigious construction. This discipline of construction that we're going into in ERC communities is well below his pay grade, because it's all horizontal. This is a guy that's done mid-rise and high-rise. So we're leveraging him to just spread out a much higher volume. So the simplicity of this construction discipline is just a no-brainer for him. And so you should see us, depending upon capital procurement, you should see this roll out pretty fast. Unlike the golf company, which today has hundreds of employees, we can own thousands of these rental units, literally thousands, and probably have a home office of less than 10 people, because so much of this is outsourced, all of your general contracting and everything. So Ryan's job is really managing outsourced parties in engineering, architecture, urban planning, real estate brokers, and of course, general contractors and subcontractors. So we feel we're a pretty good team for this. Go ahead, Mary. I feel like I'm talking super fast because I want to save time for questions here. This is something that this window here is one of the most important windows, or one of the most important screens of the discussion tonight. And I don't get into this too much. It's not addressed too much in the investment offering work, but this is a very, very critical thing. We bring in equity and we borrow construction financing to build these communities. Question comes, what happens when that construction financing is due, which is typically a couple, 3 years after we start construction. So we have to come in with mortgage financing. One of the driving forces that convinced me to go ahead and do this was that our investment bankers up in New York City advised me that they could get us federal agency financing. Federal agency meaning Fannie Mae, Freddie Mac. That's all solicited bond financing. And those two agencies have a real penchant now, a real strong desire to be in the affordable area. A lot of that comes from Congress. These firms have tremendous congressional oversight, and there's a big push on affordability. So they have approved our manufactured home committees for full mortgage financing. That is to say that two federal agencies there essentially honor our development plan is quite a feather in our cap. And for you shareholders or potential shareholders is really one of the key legitimizers of what you would be investing in here. It doesn't get talked about that much, but it's a critical thing. Hey, Jerry, you're going to build this thing. You're going to owe tens of millions of dollars to the construction agencies. How are you paying them off? Well, this is how. And so it's a very critical piece of this. We're very proud of this. In fact, it's interesting. We're firmed up on this while in fact we're finishing up certain of the construction features of getting the sites built, which are probably wrapping up this week or next. We've broken ground, and we're about to enact our first construction loan on the first 60 sites. But this here, very, very important. I'll take questions on that tonight. I'll take questions on that, in direct discourse with me. Go ahead, Mary. Yield. Yield. This is a dividend producing stock. So you have an objective hard yield of 10% on your money. Invest 20,000, 2,000 a year, 500 a quarter. Very simple. That's the objective side of the investment. There's a very strong subjective side, and that is, how does the investment grow? I use a term called leveraged equity, and what this means, this is kind of what we call level 2. This is ERC Communities 2.0 now. And I'll try to do it keep it as understandable as possible. Rounding off numbers, let's say we build a group of a community for $10 million. We project and have good evidence that that community will earn $800,000 a year. That 800,000, if you pull out your calculator, is an 8% yield on the $10 million. In today's world, 8% yield on real estate is very high, very high. Office buildings, apartment buildings, medical buildings, assets like this are trading at yields of 5 to 6. Of course, the lower the yield, the higher the value. This point number 2 is why I founded this business. We are being told by the people on the prior page, Fannie Mae, Freddie Mac, and our investment bankers at Walker Dunlap in New York City, they think that this asset grouping should value at 5.5 to 6%. So you're going to say, well, Jerry, what does that mean? It's worth less than we do? No, it's worth more. Because if you take an $800,000 income, which remember, 800,000 is 8% on 10 mil, but you take the 800,000 and factor it at 6%, it's a $13.3 million value. What does that mean? It means that we spend $10 million to build the asset. When we're done, it is ostensibly worth $13.3 million. And that's presuming the Russians don't attack us, the Chinese don't build military bases in Cuba and attack us. I mean, it's presumed the world stays pretty much the way we've known it the last several decades. I always have to caveat that. That is leveraged equity. That is yield spread. That number 2 is the real reason you want to do this. Number 1 is great. You want the dividend. I'm all for it. But it's a very current, very predictable, objective rate of return that gives you a sense of safety on your money. But number 2 is where the real gain is. Now, if we have an asset worth $13 million, it could be that Fannie Mae, Freddie Mac will give us mortgages of $9 to $10 million. Well, what if they give us a $9 million mortgage? Well, on a $10 million construction, we will have invested $3.5 million to $4 million in that asset. If they give us a $9 million mortgage, what does that mean? We're going to pull out equity from the asset, use that with additional share sales that we're doing to grow the company. And what you get is a real exponential growth. We call that replenishment. And I have done a lot of this in my life. And however, my life was principally dedicated to buying existing assets. We don't want to buy existing assets because if we do, we're going to buy them to a 6% yield. We want to build the assets to an 8 or better and value it at 6 or under, and then maximize our mortgage capabilities to take that capital, mix it with new share sales, and grow this company. We're starting off here 165 plus across town another 90, 255 units here. It will take till the end of next year to get all of that done. But as we're getting that done, we will be buying new parcels of land to put into construction for the tail end of 2024, let's say, going into 25, and get this company to a point where it's developing at least a couple thousand units a year, developing and opening up for rental at least a couple thousand units a year at our current price, at our current cost. I don't know if my calculator goes as far. That's $400 million of annual development. And that is a range that we should be very comfortable with doing. We will debt finance roughly 75 to 2/3 to 75% of that. The equity that is then needed will be a combination of this replenishment we pull out of existing properties and, of course, new cash that we raise through share sale. Those of you in at this stage on ERC are in a very good position to be kind of ground floor as all this explodes out. This number 2 is, and Ryan, you and I have talked about this, this number 2 is it theoretically could be a 1-hour webinar of its own, or maybe I just do a call with, maybe there's half a dozen people and just do a private call with me. That number 2 is, ERC 2.0. That's really what, that is the real reason you want to do this. Go ahead, Mary. What's the result? Cash flow in excess of dividend rate. That cash flow in excess of dividend, of course, is what we reinvest. Equity replenishment coming out of refinancing for reinvestment and continued share sale at higher share prices. You want these share prices going up over time as compared to the prices you've paid. That has a connotation of value. Those 3 factors, cash flow in excess of dividend, equity replenishment, cash pull out from permanent financing, and then continued share sale equals leveraged equity growth. Again, big topic. Let's get a handful of people talk to me who want to, or do another webinar. I want this well known. I want this very well known. It's a very important factor. Go ahead, Mary. I already went through this. I already went through this. This 1, 2, 3, and 4 is what I just described to you. 8% yield, valued at 6. The yield spread is 2 percentage points. It's actually, we also call that 200 basis points, and it means that a $10 million asset could value it north of $13 million. This is just kind of repeat. I've already been through that, but it's a good slide. It's a good slide to keep in mind. Go ahead, Mary. And that's it. Now we talk about how to invest. Ryan, why don't you chime in and talk this through a little bit, talk about the websites and phone numbers. I don't think we have an 800 line here or whatever, but if you want dividend stock in ERC communities, you know, this is going to be the last time you're hearing it from me, because next webinar is Thursday night next week, and this dividend Reg A stock is going to be gone. So
I'll put the contact info in the chat here.
Okay, the phone number too, huh?
You got it.
Okay. So Q&A, huh, Mary?
Yes, let's jump in. So we have a question from Mark, and please, if you have any other questions, feel free to add them to the Q&A box at the bottom of your Zoom bar, and we'll get your questions answered. So we have the first question from Mark. What about the weather threats, hurricanes, tornadoes, to one's investment?
Well, in what's going on in both companies, it's an interesting question for the golf company too. I facetiously say that our true joint venture partner in these two companies is Mother Nature. She runs havoc on the golf company, let me tell you, sporadically. We are not building these communities. There's a couple of answers here. We're not building these communities near the coast. We're on elevated land. Now, elevated land in Florida means, 50 feet. If you're at 50 or 100 feet in Florida, you're basically in the, you're in the Andes, or you're in the Himalayas, because down the southern half of the state, we're pretty flat down there. But we don't do coastline. The homes are manufactured to very strict FEMA and FHA and HUD specifications. In many ways, they're stronger than conventional built homes. They're built under roof, so they're dry. They're tied down, very tough specifications. In these hurricanes you've seen here in these last few years in Florida, you do have all kinds of damage, conventional homes and manufactured homes, but all coastline. It's all very limited to coastline, coming in probably, I don't really know, probably coming in a couple miles. Zephyr Hills is probably 40 miles plus from the coast. My guess is it's about 40 to 50 miles from the coast. So we're just not too bothered by weather. Neither are the mortgage lenders, neither are the construction lenders. It just doesn't seem to be much of a concern.
Sounds good. All right. So we have John here asking, what is the cost to develop per unit, including day unit? Does it compare to stick built from the ground up versus buying existing multifamily?
We're scheduled right now at $200,000 a unit. The home itself is raw, meaning just coming from the factory, 80,000. We spent another 20 to 25,000 setting it up, and the rest is in preparation of the land and the permits and buying the land itself. That square footage of a brand new home today in Florida, in the area like the Zephyr Hills area, a brand new home would, at that square footage, would easily be in the high 200s, pushing 300,000. Now, that said, the single family home, the traditional built home, is going to be on a larger piece of land. Okay, so that accounts for some of the price increase. But if you want a 1,400 square foot brand new home, 3-bedroom, 2-bath, you're going to be pushing or beyond $300,000. But you'll have a larger lot and you'll have a covered garage with garage, which we don't. Multifamily, my hunch is I'm not directly in on multifamily pricing right now, but with the yields where they are, I think that a traditional 2-bedroom, 2-bath, 1,100 square foot apartment is valuing today in the $25,000 range. There are not many 3-bedroom, 2-bath apartments. A very small percentage of your apartments in these multifamily projects are 3-bedroom, 2-bath. They're probably valuing it. They're probably valuing it at 265, 270. So our cost and value, or at least our ingoing cost, is way lower, and that's obviously why we're doing it.
Good. We have another question here. What's the amount of debt for ERC manufactured home investment? Is it debt fixed or variable rate? And when are the debt maturities coming due?
The construction debt on these developments are right at 75% of the cost if you include the land construction and the home financing. They are absolutely variable. No one will give fixed rates in this environment on development construction. For construction. Now, when we convert to the permanent takeout loan, the permanent mortgage with the 2 federal agencies there, those will be fixed rates, and those loans typically amortize over 30 years, and they're due and payable in 15. So they're very comfortable due dates on those loans going out. There are other pieces of debt that we can acquire that are fully amortized and never come due. I'm not too worried about a 15-year mortgage because we're not going to stay in these assets that long. And the equity will probably build so much that the mortgage doesn't really have much value. However, they're valued in a monetization or sale, merger, anything like that. It'll all have to be refinanced. And so that's the answer there. But this is pretty comfortable financing. You know, rental housing today is frankly one of the most desirable forms of equity and debt financing there. Office building financing, whole different deal. The world's in a panic over office buildings right now because no one knows. You know, a bunch of loans are coming due that are in the 3 and 3.5% range. They have to be refinanced at 6 and 7, and they've gone partially vacant. You know, so their appraisals are coming in less. But your desire for financing from the institutions is very heavily focused now on rental properties. It's the most stable thing that they can finance. So we're pretty confident there.
All right. So we do have another question about taxes. So would the ERC issue a K1? How would that work?
We don't issue K1s. The K1s are issued by partnerships. We are a corporation, and you get a 1099 showing the dividend you paid, and it is shown as non-taxable. So there's no K1s issued here.
All right. We have the last question here. So if you have any other questions, please feel free to add them to the Q&A box. So we have here Steve asking, other than the 10% annual dividend, how else do the investors make money? Is it only with an increase of the share price, or is it the profit?
Or is it what the profit on the, I lost that last couple of words.
Sorry, is it only with an increase in share price, or is it there any other profit sharing?
The increase in share price is the profit. When you own shares in a corporation, in this case here, under the current Reg A, you have 2 functions. You have 2 pots of income. You have the dividend that you're collecting, and then you have, you know, what's going to happen to my share price. To the degree we succeed in our business plan with leveraged equity, with rental increases, with the expansion that we plan, your share price goes materially up. Now, under Reg A, I'm not even supposed to say that. The SEC has very strict regulations on, you know, how fast can I double my money? I have a good sense of how fast you can double your money, but I can't say it by law. But obviously, this is a growth-minded asset. You're going to own shares in this company. You're going to make money 2 ways. You're going to collect a dividend, and you're going to take a risk that your share price at time of sale, time of merger, time of IPO, initial public offering, whatever that may be 5, 6, 7 years down the road, you're taking a risk that share price is going to be higher than the preferred price you paid. Remembering again, the least you can get back is your preferred, you know, what you invested, but the risk for value is in my opinion is going to be greater than the dividend rate. I think the growth itself will be greater than the dividend itself, so that it should compound very nicely. But there's no this isn't like a partnership where we sell an asset, share the profits. The corporation retains all this for the benefit of its shareholders. Again, I'll take separate calls on this if that question leaves anybody, you know, unclear.
All right. So can the dividends be reinvested, or rather than taking redistribution?
No, not yet. We have so much inquiry on that. And we probably have in the two companies combined under Reg A, my guess is we have 500 to 700 or more people who want to do this. It's very troublesome under Reg A because of the federal rules. Literally, if you own 5,000 worth of stock and you have a $500 dividend, you have 125, a quarter. That 125 acts like a brand new share sale and has to go through this whole process of administration. It just wipes out the benefit of what they charge us to do it. So unfortunately, that's a cold no. Shares cannot be reinvested at the parent company level. Our parent Reg V offerings do allow that. But that's not what we're talking about here tonight. So but under Reg A, unfortunately, we can't reinvest dividends. I doubt that we're ever going to be able to pull that off. It's just administratively way too difficult.
Okay, so Chris is asking us, do you do joint ventures?
Yes, we do. We have two joint ventures in the golf company, and we have a joint venture memo in circulation now for ERC. So someone who is interested in joint venturing can come in and actually, instead of owning stock in the company with a much larger sum of capital, can come in and own a piece of the actual asset and thereby take depreciation write-offs, share in cash flow, stuff like that. That has to be a call with me. That's a call with me and me alone to walk through and kind of, understand. I have to understand what the investor, really wants. I've done a ton of that in my career. I've worked with institutions and very large, wealthy families. One family alone in the mobile home park business in the 80s and 90s invested over $65 million with me. That was just one guy writing out of his checkbook. So I have a lot of experience with, that kind of structure. Very common, very easy to do, but that has to be done with me.
Sounds good. So Mark is asking, so it says actually, it sounds like time is on the essence. Therefore, where's the quickest way to invest right now?
Ryan, why don't you chime in on that, okay?
I put the link to invest on the chat for everybody. So go ahead and click on that. It's just invest.erccommunities.com. Or you can also email the email there as well, which is investors@erccommunities.com.
Time is of the essence, that's for sure. It wouldn't be so much if we weren't discontinuing the dividends. But we have an awful lot of people who want to come in that don't want the dividends, so we're switching over to that. So if you want dividends, which is very nice, I think you want this, then you want to get on this tonight, tomorrow, and don't, because we're coming into a holiday weekend, and it might jam up a little bit.
That's true. Okay, thank you everyone for attending. In case you came in late, feel free to reach out to us and send any other questions you might have, or the recording to investors@golfsuites.com. Is there anything else you would like to add, Jerry, before we?
Well, you just said investor at Golf Suites. It's really ERC community, but Ryan, it doesn't. You talk interchangeably on the email addresses, don't you? I mean, if you're going to invest in ERC, you have to go to invest.erccommunities.com.
Yeah, if anybody's interested in the Golf Suites one as well, I'll put that into the chat right now.
Okay, good. Well, thanks, folks, for joining us. I appreciate taking your personal time, and we'll be back again Thursday night. These are Jerry's Thursday night fireside checks. I got no idea what I'm going to talk about next week, but we will be back. So thank you, Mary. Thank you, Ryan.
Sounds good. Thank you.
Okay, bye.